So you want to trade options better. I know you do, because you clicked on this video. You keep taking L's. Big L's, little L's, lots of L's. Those losses are piling up, and your gambles on meme stocks rarely pay off enough to make up for those losses. The options you're buying expire worthless. Or maybe they don't even increase in value when the underlying moves in the right direction. Or you're like me, and you've watched plenty of winning trades go to shit. With a few tweaks to your trading strategy, you can turn this around. You can stop burning your money and start making some profits. Or you can keep doing what you're doing and watch your account size slowly decline. But if you're like me, you want to change up your trading strategy, stop making the same mistakes over and over again, and improve your P&L. The first thing we're going to look at is just buying better contracts. I mean, that should be the beginning and end of it, right? Wrong. There's more to it than that. The first step is to stop buying out-of-the-money contracts. You don't want those. They're like gas station sushi, guaranteed to expire worthless. The second step is to buy longer-dated contracts. It gives you longer to be right. And I'm sure you have a well-educated thesis beyond stocks only go up. The in-the-money contracts give you more delta, and we all want more delta when we're right. The longer-dated contracts, of course, give you longer to be right, but they also give you lower theta, meaning that your contract value is going to bleed out slower. Okay, I know that wasn't fair putting 2 in 1, but we're on to the actual number 2. Be mindful of the expected move. So your broker can calculate how much they expect the underlying to move in a given period of time, and they use option pricing to do this. Of course, option pricing is based off of what people will pay for something, and what people will pay is not always real value. So expected move is not 100% accurate, but it does give you a good idea of what the anticipated range of the underlying is in a period of time. If you're going to ignore what I said earlier and buy out-of-the-money contracts, go ahead and try to buy out-of-the-money contracts that are still within the expected move. It's going to give you a much higher chance of winning. Some brokers are really cool, and they'll try to tell you probability of profit. It's also not 100% right. Time for a bonus fact. There's a stupid notion out there that most options expire worthless. That's not true. Most options are going to be closed out before they even get to expiration, so they can expire worthless. Don't be afraid to take profit early. Oh, that brings us to number 3. Take profit early. Use whatever orders you have to do to stay disciplined. It really hurts watching a winning trade turn into a losing trade. Whenever I open a trade, I place a bracket order. Some brokers call them OCO orders. One cancel the other. Essentially, I'm telling the broker I want to sell if this thing goes down in value too much, or I want to sell when it reaches my target price. Either way, I've predetermined my exit criteria from the trade, and I don't have to worry about my emotions getting in the way and making a dumb decision. Time for number 4. Be careful about your position size. At a bare minimum, don't YOLO. It really hurts when these go wrong. You want to keep your position small, so if you're wrong about something, you don't blow up your whole account. Maybe lose a certain percent, whatever you're comfortable with. I'll risk no more than 4 or 5% on any one position in my account. That can be trickier with smaller accounts because trading some things just costs more money. To deal with that, I direct you to my video on spreads where we look at how to trade bigger things for cheaper. For those of you more interested in how to size positions, go ahead and look into the Kelly criterion. I'm not going to get into it. There's a lot of numbers involved, a little bit of math, and I just don't want to do that on this video. Number 5, you need to go ahead and pick a better underlying. Now, I mean a few different things by that. I like to trade underlyings that make money if I'm going on the call side. I like to trade ones that lose money if I go on the put side. Pretty simple. You really want to know what the thing is going to do before you enter into the trade. If you're going to buy a growth stock, go ahead and make sure that it's growing. I've seen a lot of people make this mistake. As I said, you really want an identifiable trend. To identify the trend, you might use technical analysis, tarot cards, or a crystal ball. Finally, there is an optimal volatility for underlyings you're going to trade. If it's too volatile, the options prices will be prohibitively high and you're going to find it almost impossible to make profit. This happens a lot when people try to FOMO into meme stocks. Don't FOMO into anything. Some of my best trades have been on relatively boring, low volatility tickers when I get in the right time and volatility expands later. Go ahead and check out some of these other videos filled with trading techniques, strategies, and other useful information like how to understand the Greeks, which are very important if you want to trade better and understand why your option prices are like they are. Thank you for watching. Bye.